Hi everyone, it's John Parisi and it's Friday, February 16th, 4 o'clock. We just closed up another trading week. So we are exactly 1.5 months through the 2024 trading year, and it's been one hell of a year. I've been investing on behalf of others professionally for 35 years now, and this is easily one of the strongest bull runs I've seen. We have been dialed in. The market is playing out exactly as we had planned and hoped. If you go back, and I encourage you to watch our other videos, particularly in August, September, October, that 10% pullback that we saw in the fall, that we confidently and consistently bought into, and are very on the record for saying that we absolutely love the investment landscape for investors, and particularly for retirees, just given that rates being high enough to make money on your cash and bonds, but not high enough to really throw us into a recession. So it's been, like I said, one of the strongest runs I've ever seen in my career. We are up 23% in the last 4 months from the bottom in October. That annualizes, if it did that every 3 or 4 months, we'd be up 70% for the year. So really, really strong move off those lows. At the end of January, the markets were up 2.5%. Well, we're 2 weeks into February and we've doubled that. And we're up 5.6 in the S&P 500, 5.9 in the NASDAQ. May not sound like a lot of money, but in 6 weeks, that annualizes out to a little over 45% per year. Stocks average 9 or 10% a year over the long term. So this has been an incredible run. The markets are at all-time highs. If your portfolio is not at an all-time high, then you're probably not positioned correctly to take advantage of this, because not everything in the broad markets are moving at this pace. It is very stock specific, very industry specific, and if you or your advisors are not positioned accordingly, you need to rearrange your positions. But again, your portfolio should be hitting all-time highs in here. This is easily as strong as, especially in technology, this really reminds me of what the market felt like during the tech bubble from 95 to 99. But the difference between the 90s and today with what's happening in technology is that was all potential for the internet, right? E-commerce, going online, devices, etc. It was all just Wi-Fi was a term none of us really understood. But there were markets going up 100, 200% a year just on the anticipation of that. It would take 20 years for that to really fully develop out, including one hell of a correction when the tech bubble popped in 2001 and 2002. Today is quite different. You're seeing an entirely new wave of technology develop and get employed into the system. However, this is based on real orders for products and services and real revenue and real earnings for these companies. We've been pretty vocal that one of our largest positions, it's now our number 3 position in the firm for our individual stock portfolios. We did not buy NVIDIA for AI. We bought NVIDIA starting in 2017, but really went across the board with our client base in 2020. And we bought it for gaming. They were the number 1 gaming chip manufacturer, and they had the best technology for those cards for video graphics. And, just seeing what Xbox and PS5s are doing in the world in terms of sales, we wanted a piece of it. Then their next wave, kind of in, around COVID, et cetera, was they moved into chips that drove the blockchain and Bitcoin mining, et cetera. And we wanted a position in that. And then China blocked Bitcoin mining. And, again, all these chip stocks kind of cratered and Bitcoin cratered. And today it's all about artificial intelligence. Artificial intelligence cannot be underestimated. Forget about the term AI. What this really is this is just the next broad wave or cycle of computing power in our industrial infrastructure. So every company is going to have to take advantage of this, just like they got into computers and then they all moved into the cloud, et cetera. Well, now it's going into large language models and superior computing, and companies aren't going to be able to exist. Take a company like Target. You've got millions of shoppers, millions of customers that all have very particular patterns in the stores around wherever they have stores. And now the computing power can articulate what each person is doing, how their shopping patterns work, and help the company position inventory, pricing, having products in certain geographic zones, and then also market specifically toward you with what your habits have been. So, and it's not just NVIDIA, it's all the ancillary products. So Lam Research makes the machinery that generates chips. Taiwan Semiconductor creates actually the chips that NVIDIA buys, and then NVIDIA structures them into their super chips. And then Microsoft takes those chips and makes them into applications that the average individuals can use. So we've got positions in all of these things. And but here's what's funny about 2023 and 2024. It's just not technology. You know, we have a very large position in Eli Lilly. It's going to have what we believe is going to be the biggest selling drug of all time, possibly hitting $1 trillion. Weight loss, diabetes, but also, you know, heart disease, sleep apnea, alcohol consumption. It really combats a lot of things. So that's going to be a super pharmaceutical that we think as much as 10% of the population will be on over the next 10 years. Our top 10 stocks, just to let you know how we're doing here, these are all publicly listed on our 13F. They've moved quite a bit since the end of the year, so I'm just going to give you where they are today, but you'll see these in our publicly filed 13F with the SEC. Our top position is Microsoft. It's up 70% in the last 20. I'm going to give you numbers from 2023 to first 6 weeks of 2024. So a year, basically 13 and a half months. Microsoft is up 70%. Apple is up 40%. Our third highest stock is now NVIDIA. That's up 401% in the last 13 and a half months. 401% in 13 and a half months. MasterCard, a core holding here for over a decade, up 40%. Google, up 59%. JP Morgan, 33%. Home Depot, 15%. Meta or Facebook, 294% gain. Berkshire Hathaway B shares up 31%, Costco up 58%, and Eli Lilly is our 10th holding. That is up 114%. So again, all this stuff is publicly available. But again, you need to be positioned in these sectors, and it's not just tech right now. So what are we looking at for the rest of this year, 2024, and into 2025? So let's first start with the Fed. It is our belief here that we're looking at 2 cuts. We never bought into the 5 to 6 cuts, 7 cuts. We certainly didn't think March would happen. We're looking at 2 cuts, possibly 3. They're going to happen probably in June, and I think you'll get something like maybe 1 or 2 before the election. Then they're going to go quiet, kind of, you know, after August meeting. They can't do much in front of an election. So they're going to wait till after the election. Maybe we'll get another cut toward the end of the year. The main goal of the Fed that we'd like to see is that they uninvert the yield curve. An inverted yield curve is when short-term rates are higher than long-term rates. We need to get that back to a steep yield curve. So if you're investing for a year or 2, you're getting a lower rate than if you invest for 5, 7, 10 years. And without getting into it, that needs to happen for the economy to run on all cylinders. So we hope that that's their goal. But again, we're looking at two cuts. Our year-end target when we started the year for the S&P 500, we entered the year at about 4,700. We set it at 5,100, up about 8%. We got to 5,000 really fast. And every correction we've seen has been bought and rallied right up to new all-time highs. So we're going to extend 5,100 out to 5,200, but we really think that's the max in terms of fair value. Anything above that, unless the conditions dramatically change, is going to be overvalued market. So, you know, what does that mean? Well, if we're at 5,000 today and our target is 51 to 5,200, we're probably going to have some sideways actions. And I wouldn't be surprised to see the market soften up as we move, you know, let's say past April, soften up into the summer. And at that point, the next boost is going to come from, you know, rate cuts. I think the Fed will cut rates. Forget about timing it. Forget about the number of them. But as far as when we think the Fed goes is when CPI gets to 2.7. It can print at 3.1, it can print at 3, it can print at 3.4. When it gets under 3 and 2.7 is my number, that's when you're going to see the Fed say, okay, we need to start cutting now because they don't want it to accelerate on the downtrend and break below 2 and get to 1 or even negative disinflation. So the economic system doesn't really work with that. You need pricing power for the capitalistic system to work. So again, we're looking at 2 rate cuts, second half of the year, maybe 3. A geopolitical event is really the big concern, and that can change the picture dramatically very quickly. What's going on in Gaza, what's going on in Ukraine, the election, there's a lot that can happen out there. So positive on 2024, but let's take a break here for the next few months. Markets are overbought. Anything can and will happen in the market. So if the market keeps going up, we're going to continue to ride up. And any pullbacks, meaning 5, 8, 10%, we will be buying into. We are getting record number of inflows of new cash, assets under management to our firm. Boy, it's a tough problem to have. It's great to receive new clients, new assets, but how do you deploy those into a really hot running market up here at all-time highs? And what we're doing is we might put a quarter of the money into work now. Like if you had 100,000, a million or more, or 10,000 to invest in the market, we just simply say do 25 to 30% today, and then divide the rest between now and let's say November, and do an equal amount each month. We do it on the 1st and the 15th of every month. And we work the money in slowly. So between now and the election, you're going to get a nice average price. Then the election will be behind us, and you're going to be looking at the strongest season of the year every year. The November, December, January just tends to historically be the best time to be invested. So we'll take the between now and then to get invested, and then from then on we'll hopefully the market rips. We are in a sweet spot in the market. It's what we call a Goldilocks environment. Not too hot, not too cold. Earnings per share, economic growth, all the economic indices, unemployment is stable. Employment is stable. Unemployment still near record lows. And it's all good enough to keep the economy growing and good for the stock market, but not enough to stoke inflation, which is going to cause the Fed to either hike rates more or certainly keep them elevated for longer. But as we have said, and go watch our other videos from the fall, particularly September and October, we love this setup for investors, especially retired investors. We're making 3-4% on safe money in the bank, but skip that. We've got all of our cash management going into short-term treasuries. We bought 5.37% yesterday all the way out to August. So we're putting away money for 6 months. When two-year notes were up above 5%, we were getting 5.10 for 2 years. And we're locking that in as a cash equivalent. So our retirees are making over 5% on their cash. Bonds are making between 5 and 7%, depending on the credit quality. And then stocks, we think we're in a really good environment where the rate hiking cycle by the Fed is done. The next moves are probably lower cuts, but we're in no rush for them to lower. I love these front-end rates. These are great rates for retirees or anyone who's got cash savings. So if you make 9 or 10% historically over the last 50 years in the stock market, and you're waiting for a pullback to get in, and you can keep that cash safely making 5.3%, more than half of the long-term returns on the stock market, risk-free, while you wait, that's the best setup we've ever had. And that's why I think every pullback is going to be bought. And again, unless there's a great geopolitical situation that develops, you're not going to get too much of a correction. As we head into 2025, here's where things, at the end of the year, here's where things get a little excited. We think you're going to see, and this only happens a few times in a career, we think you're going to see one of these coordinated campaigns by global central banks around the world in a rate cutting campaign. And that is what's going to set up the next great wave of economic expansion globally. And there are going to be opportunities not just in the United States and not just in technology, but it's going to be global and in emerging markets. And that could be quite exciting. So, I'd say we have 6 months between now and the summer or before the election to kind of slowly deploy money into the market, slowly, systematically. Don't take a lot of risk up here. Be patient. And as we get those pullbacks, confidently buy into them. If something changes, we'll let you know. But then get ready for a more exciting, end of the year, and potentially into 2025 could be just historically strong. So that is it for today. We're going to wrap up the week. Again, all-time highs. We're in a really good position here. We're not taking money out of the market, but we're being very specific of where we want to put it in the market. So if you have any questions, any concerns, don't hesitate to shoot me an email, call me up. And with that, I just wish everyone a great weekend.